There's an old saying that April is the cruelest month, and that certainly seems to be true for taxpayers. April 30th again this year, it's the filing deadline for most individuals. Now you can file later than that if you like, if you don't owe money. If you do owe money though, there are penalties for filing late. If you or your spouse are self-employed or have self-employed income, you get until June 15th to file without penalty. However, even then, if you do owe money, you have to pay by April 30th like everybody else. Otherwise, you will be charged interest on late payments. For investors, it's time to gather up the information slips that by now your broker, your dealer, your financial services institution should have sent to you. Now these include dividends, Canadian dividends, particularly because they are eligible for a tax credit. Interest income, such as from GICs, for instance, or from bonds or bond funds. Other income, and that includes foreign dividends, because foreign dividends aren't eligible for for tax credits. And it also includes capital gains. Importantly, there are two types of capital gains. One is derived from trading profits within a fund or a mutual fund or exchange traded fund that you own. And those are going to be specified on your information slips, the amounts. The other type is trading profits of your own, or losses, of course. And that's if you sell a holding. Now these you have to deal with separately, report them. And you can get help from your financial advisor or institution to get the adjusted cost base in order to be able to report your profits or losses. If you're holding investments in a registered account, such as an RRSP, you don't have to worry about tax information slips of this nature. That's because any assets held in an RRSP are tax deferred. Now, that doesn't mean that you escape taxes altogether. You are taxed on your withdrawals, and the bad news is that you're taxed at your highest marginal rate. Now that we're past the first 2 months of the year, it's too late to make any new RSP contributions for the 2015 tax year, but it is time for you to start thinking about 2016 and whether RSPs have a place in your investment strategy. The advantage of RSPs is that income is deferred from taxation, and secondly, that you do get a tax refund according to the amount that you invested and your marginal tax rate. But for people who might need to withdraw from their RSPs before retirement, the RSP has significant drawbacks. That is, that if you make these withdrawals, you're not going to be able to regain that contribution room. There are a couple of small exceptions. One is for home buyers, and the other one is for the lifelong learning plan for students, including mature students, but those affect a very small number of people compared to the total number of taxpayers. Tax-free savings accounts, by comparison, are much more flexible for everyone. You can make a withdrawal from a TFSA and regain that contribution room. The only thing is you have to wait until a subsequent year to do so. Otherwise, you'll be in an over-contribution position and subject to penalties. And also with TFSAs, unlike RRSPs, when you do make your withdrawals, there are no tax consequences. Finally, if you have children, even if they're still in diapers, one of your top priorities to consider ought to be a registered education savings plan. That's because in addition to the money that you contribute, you get some grant money via the Canada Education Savings Grant. And this offer of free money from the government is just too good to pass up.